The property market is going gangbusters. The theme is property overvalued? Will first-time home buyers ever be able to get into the market? In reality, as investors, it's not really going to change my investment decision. I'm investing today so that in 10 or 20 years from now, I'm going to be miles better off.
It's just another good reminder that when we're investing for the long term, we don't let these things distract us or take us out, because they are going to happen. We just don't know when.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to the show, Stuart. I'm really excited to be deep diving on one of your larger analysis again, which I think the listeners are going to be really interested to hear.
Yeah, thanks, Jared. It's always good to get together. I always enjoy our chats, and I'm looking forward to today's one.
Well, I was listening to your podcast, Investopoly, as I always do, and you went through a really interesting analysis where you looked at historical performance over different periods of time, and some of your findings were really interesting. And I'm asking the question myself, what do we expect for the next 20 years? And is it going to be more like the last 20 years or the previous 20 years to that? And are we going to return to higher growth rates that we saw previously, or is it going to be more of the same that we've had? So take us into what you've been looking at and some of the findings.
So, Jared, I looked at the last 20 years in terms of capital growth returns. And the reason that I did that is quite often the media will focus on what has happened over the last 1 or 2 years. And of course, that's what we're most interested in, because it's about the now or just yesterday, and it's sort of fresh in our minds. So, if the property market is going gangbusters, the theme is property overvalued? Will first-time home buyers ever be able to get into the market, etc.? And when it's negative, the theme typically is property is going to drop 20% or something like that. That it's always quite sensationalist. And my typical response to that is go, okay, that's good, but let's look at sort of longer-term returns, medium to long-term returns. So let's see what property did over the last 5 years, last 10 years, last 20 years, and so forth. Because you've got to have the context, right? You can have a great year in property, but if the preceding 8 years were terrible, well, big deal. And so when doing that analysis, that's what sort of highlighted the last 20 years. So I'm looking at the calendar years 2003 to the end of 2023, so end of last year. And I was really surprised at how poor the capital growth had been compared to the very longer term average, so 40 plus years. And to put some numbers around it, the average of the 5 main capital cities in Australia returned about 5.3% in terms of compounding capital growth over that 20-year period. And the variance from state to state wasn't that much. They're all around, they all had pretty much 5-ish% in terms of capital growth. That's not that good. Like if you think about, inflation and so forth, it's more than inflation, of course, but not a lot more than inflation. And in particular, when you compared it to the previous 2-decade period, so there I'm referring to 1983 through to 2003, again, the average was around 8.7%, let's call it 9%. And the 2 main capital cities, obviously Melbourne and Sydney, the 2 largest capital cities, were close to 10% over that time. So when you look at Melbourne, Sydney, the most recent 20 years compared to the preceding 20 years, it's about half the growth. We've gone from 10 to 5%, and substantially lower growth, 3.5% in all the other states. So it makes you sort of sit back and think, well, which one was correct? Which one is going to be the long-term average? Is it just the growth between 83 and 03 was just overcooked, it was too high and never sustainable? Or what happened in 03 to 23 that really depressed growth rates and didn't allow us to enjoy that sort of growth that we had in that previous 20 years? And that's the big question. That's what the question I wanted to sort of focus on and talk about.
Well, I found your numbers interesting on a few fronts, because everyone in the investor community just thinks Sydney's king all the time, no matter what. And when you look at this last 20-year period, Brisbane has actually performed higher than it, and as well as Adelaide has, and arguably could have been some catch-up growth there on the preceding periods. But Sydney wasn't necessarily king over that period. Melbourne, that you'd otherwise expect to have probably pretty standout growth over the last 20-year period, it was actually one of the lowest of the capital cities with 4.8%. So very different to what the perceptions are there.
And it's good to look at these long-term results, right, Joe? Because as property investors, we're not particularly interested in what the market might do over the next 12 months. I mean, it makes for good dinner conversation and, we can debate it. But in reality, as investors, it's not really going to change my investment decision. I'm investing today so that in 10 or 20 years from now, I'm going to be miles better off. And so the best data that I can look at to sort of influence that decision making is long-term data, is to start trying to think, and it's difficult to think in decade increments because so much can change over that period of time, but really that's the best thing to do. So let's talk about what is the differences, because if you look at the averages between those 5 capital cities, the average difference in those 2 20-year period is 3.3%. So that's what we're trying to understand. What drove that 3.3% lower capital growth rate over the last 20 years? So the first one is inflation. Inflation was a lot different in those 2-decade periods. So in 83 to 03, inflation averaged 4.1%. And the most recent 2-decade period is 2.7%. So there's a discrepancy there about 1.3% that is reliant upon inflation. Now, inflation will be what it'll be. And I tend to think that, long-term average with property is sort of median house prices, sort of 4.5% to 5% plus inflation. That's kind of the long-term average. If we're going to be investors, that's kind of what we're hoping for or what we're aiming for. Okay, so 3.3% total gap, 1.3 is inflation. So then it's really 2%. That's the real difference, as in excluding inflation, that we need to sort of think about. Now, it's really tempting, I think, to think back over the last 2 decades and go, wow, it's been a pretty tumultuous period, and it really has. We've had
the roller coaster, haven't we?
Yeah, we have. And, it seems like, every year there's something that comes out of left field to create some turmoil. But, the 2 major events, I guess, in the last 20 years were the most recent pandemic. And I don't think I probably need to remind too many people about that. Of course, we're still trying to unwind inflation from the stimulus during that period. So we're kind of still living with some of the hangover of that period. And before that was the GFC around 08, 09. That was a pretty tumultuous period, particularly for banking. And obviously banking has a big impact on the property market because it influences the amount of funds that are sort of flowing into the market. So you'd look at that and go, well, okay, maybe that's why there was underperformance. But we need to have long memories because the previous 20 years were pretty tumultuous as well. I mean, Australia floated the Aussie dollar in 83 right at the beginning of that period. Now, will that have a big impact on the property market? Well, it can influence interest rates, but it's hard to isolate the impact of any one thing. Certainly, they introduced capital gains tax in September 1985. That would have had a pretty big impact on, what investors were thinking. And then the share market dropped only 45% in 1987, if we remember that stock market crash.
Black Monday, wasn't it? Yeah.
Yeah, that's right. And another really substantial change was the introduction of GST, because, that had an impact on the cost of property, but you have to pay your builder GST and so forth. So when you compare those 2 periods, it's very difficult to compare them, I guess, and compare, how severe were each of those different situations, because you've got to take them in context. But I sit back, I don't think one period was any more tumultuous or difficult than the other. I think they all had their challenges, and they're all very long periods of time, 2 decades, of course. So it allows a lot of those things to kind of smooth out. So I don't think, when I was sitting back thinking, okay, we've got 2% to try and account for, I didn't conclude that it was really the GFC or the pandemic that caused, the lower growth rates.
Well, I had Michael Yardney, our mutual friend, on the podcast a few episodes ago, and we were talking about that we can't know with certainty when these things are going to occur, but as investors, we can be prepared for the worst and hope for the best, but be prepared for the worst. And it's nice when you reflect back on all these things that have happened over 20 years and 40 years, you are certainly going to see those bumps in the road. And so it's just another good reminder that when we're investing for the long term, we don't let these things distract us or take us out, because they are going to happen. We just don't know when.
Yeah, that's right. And I guess adding to that point is there's always a reason not to invest. There's always been a reason not. There's never a perfect time, really. And as investors, when we start investing or continue investing, we've got to expect that there's going to be something that's going to cause volatility or concern. That's almost certainly going to happen over the next 5 to 10 years. There's going to be something like a pandemic or whatever it is that's going to cause that concern. Or you and I don't know what that is today, but we've got to expect it. But that's the whole point, is you want to adopt a investment strategy that's evidence-based, that has the evidence that it's been able to weather those storms and those situations, that it isn't just premised on, what is popular today or what we think might work today. It's got to weather those storms.
So there wasn't any significantly larger negative factors that occurred in either period. Was there anything that actually might else have explained or contributed to this extra 2% on average growth per year that we saw in the previous period, not the most recent 20 years?
Yeah, I think between 83 and 03, the big thing, the big standout is the changes in the banking industry. The banking industry changed a lot over that time. And whilst we go, yeah, Stuart, you're talking about the banking industry, we're talking about property, they're very closely linked. Again, if I have the ability and willingness to go and borrow a certain amount of money and invest that money in property, how easily I can get access to that money, me and others like me, definitely and directly impacts the demand for property and therefore price growth. So if we want to know what's going to happen to the property market over the next year or so, we just need to look at kind of loan volumes, and that can give us a bit of a sign. Then there's a lot of things that impact property, of course, but loan volumes can be a good sign. And so the Australian banking industry was deregulated in the 80s to try and open it up and create a little bit more competition. And those that are old enough, like me, unfortunately, will remember in the early 90s, Aussie John came on to our TVs with his commercials that will save you, we'll take on the banks and we'll give you a much lower interest rate. And at the time that he launched his business, the net interest rate margins of the banks, which is kind of how much their gross profit they make off a mortgage, was north of 4% at the time. So they're making extraordinary profits from mortgages. To put that in context, today it's about 1.8%. So it's more than halved over that time thanks to a lot of competition. And in the early 90s, Aussie Home Loans was really the impetus of that. And of course, now we know today you just have to Google and you can find literally hundreds of different mortgage managers and lenders and credit unions and banks and so forth that are out there. So when we look at the average loan size in the early 80s, people were borrowing just over 2 times their family income. And so from a borrowing capacity perspective, compared to today, it was very tight. Now, today it's closer to or north of 6 times family income. And 2 things have happened over that time. Firstly, the amount we're borrowing, so amount times income is a lot higher, 3 times higher. But also there's a lot more double income families in Australia than there were in the early 80s. In the early 80s, it's kind of rare for both spouses to be working. In fact, my parents remind me that when they went and got a home loan in the 70s, they wouldn't even include the wife's income. It was just going to be the husband's income because, you're a wife, why would you work? And so that's changed a lot. And so it's changed with, I guess, the way we live and work, as in people tend to, when they get married or if they have a partner, they tend to be a professional couple or a working couple for a lot longer before they start a family. Whereas again, 40 years ago, that wasn't the case. And there's more double income families, as I've said, and then the amount that we're borrowing, it's almost a self-fulfilling prophecy really, because the amount we have to borrow is larger as well, is substantial. Now, I think before the GFC, it was not uncommon to see clients that were borrowing up to 10 times their income or sometimes in excess of that. Now,
And I think back to when I was starting out, I really pushed the needle and stretched every, single dollar of borrowing capacity and had it out there working for me. And I would have probably been at that end of the spectrum too.
Yeah, and look at the credit industry, the banking industry at that time, as we sort of got a window into it through the recent Royal Commission, was pretty aggressive. It was really just about selling loans, and if they get it across the line, if they could massage some of the numbers, they would certainly do that. And so
with no doc and low doc products that really had little paperwork needed, as the name suggests, and it did open up lending options and enable people to build much larger portfolios than we can today.
Yeah, 100%. Now, the low doc and no doc weren't as abused as much as they were in the US, but they're certainly out there, and there were certainly accountants signing off income statements and whatever declarations that had no relationship with reality. So they were certainly misused by some people. So really, then, if you look at borrowing capacity and how it had changed since the early 80s through to the GFC around 08, 09, it had changed considerably. Like, it's huge. It's a substantial change. Now, if you have a look at what's happened since the GFC, particularly as a result of the GFC and then a result of the Royal Commissions and tightening from regulators, in the last 10 years, borrowing capacity has tightened substantially. And to the extent that APRA, the government organisation that regulates the banks, thinks or believes or classifies anyone that borrows more than 6 times income as a high-risk customer. And so now sort of borrowing around that 6 times income is, I wouldn't say it's easy to do. It can start to become challenging, whereas remember I said at the beginning of GFC, 10 times income wasn't unusual. So I think that's had a big impact. Firstly, it's had a huge positive impact in that preceding 20-year period from 83 to 03. So it's had a really positive impact. And then the changes in borrowing capacity, so it unwinding itself a little bit, has had a negative impact in the latest 20-year period. And markets will have to adjust, right? Because if I'm a buyer and I can afford to pay $600,000 because I have a higher borrowing capacity in 2008, and the same purchaser now can only afford to pay $500 because my borrowing capacity is lower in 2023, of course my purchasing power is low, and that's going to reflect in the market. So I think that it's an accentuated difference, because in one 20-year period it was a positive contributor, and in another 20-year period it was a negative detractor. And to my mind, that's the only thing I could point to. And I'm sure there's a lot of things, and I'm sure it's not just one thing, but that's the most material differential between those two 20-year period.
Yeah, that makes a lot of sense. So what do you think is more likely to happen in the future with that in mind, and how key finance is to all of this?
Look, in a rising tide, all ships rise, right? And so, it's almost that you could have bought any property in Australia in the 80s, and today you'd be sitting on a hell of a lot of equity. You actually didn't have to do a lot right in order to make a lot of money at a property. You just needed patience. If you had the patience to wait 4 decades, it was all good, and you're probably sitting on a 8-9% compounding return in terms of capital growth. That, people will be looking back and going, well, wasn't that just easy? The problem is that we can't rely on, or at least I don't think, or I caution investors not to rely on, is a massive change in borrowing capacity over the next 20 years. So that contributor that was previously there, I don't think it's going to present itself again over this next 20-year period.
Can't see it becoming more free. You think it might become tighter, and maybe, the government needs to do something about incentivizing investors, but I don't know if it's ever going to be through increasing borrowing capacity to bring about more rental properties. But that remains to be seen, but unlikely.
Yeah, I think it's unlikely too. And by changing borrowing capacity rules, we might stimulate the market, but we'll only stimulate a segment of the market.
Yeah,
and maybe the wrong segment that you don't necessarily want to stimulate or encourage to take silly risks. I wrote about this a while ago. I think what they'll have to do to encourage investors back in the market is maybe provide additional tax incentives for investors that rent their property continuously for, say, 10 years or something. So instead of having a 50% capital gains tax discount, maybe you get an extra 10% discount, so your total discount 60% if you have rented the property continuously for 10 years. At least that keeps the rental stock in the market. It makes people really focus on long-term, saying, I will be a long-term landlord, and then that'll increase supply. I think that's a much better way to do it, other than to try and encourage people to borrow their way into the property market to increase rental supply. So I think there's two things that property investors need to be more conscious of now compared to what they had to do maybe 20 or even 30 years ago. The first one is that they've got to be more conscious of property cycles. So at what point of the cycle are they entering into that particular geographical market? Because we know that property markets move in two distinct cycles. A flat cycle is followed by a growth cycle, is followed by another flat cycle. And these cycles tend to last historically between 5 to 10 years. Now, they can last longer than that. Perth's recent flat cycle took about 15 years. Obviously, they've entered into a new growth cycle, as you'd well know. Jared, I'm sure you've spoken about a lot of times. And that growth cycle will probably, last for, well, who knows, 5 to 10 years is what history tells us it will probably last for. So if you buy just before a flat cycle, that can be problematic. What that means is you need to hold the property for just as many flat cycles as you do have growth cycles. So you might buy just before a flat cycle and see no growth for, maybe 10 years. Then you'll go through a growth cycle of maybe another 10 years. And over that 20-year period, your average return over that period of time has been okay, but you've had to wait 20 years in order to earn that return. However, if you can buy just before a growth cycle, and remember, it's really difficult to pick. You can pick undervalued markets, but no one really knows the exact date when that market's going to turn around. But if you can buy just before a growth cycle, well, you'll get that growth cycle, maybe the last 5 to 10 years, then you'll probably get a flat cycle, and then you'll get another growth cycle. So it's quite possible you hold that property for 20, 25 years, and you've enjoyed 2 growth cycles and only 1 flat cycle. Your return over that period of time, your average return over that period of time would be much, much better. And if we know the long-term average, if we think the long-term average is going to be around 5.5%, well, if you can get the timing right, you might be able to actually increase that ultimately over that long period of time to maybe 7, 8, 9%, something more akin to, what we experienced between that 83 and 03 period.
Makes sense. It's interesting to hear you talk about timing cycles more and the importance of that, because you do focus on the long term and purchasing the right property, of course, and nothing that you do in the shorter term is going to take that away. But it does go to show how much extra ahead you can be over any 20-year period if you get this timing right.
Yeah. And like I said, you don't always know exactly when that market will change, but the signs start to become more and more compelling. And what I'm really referring to here is mean reversion. I just wrote another blog, Jared. I did a presentation at our office at the end of 2018. I built a thesis to say why I thought the Brisbane property market was a great investment. At that time, it had been through about a 10-year flat cycle. Brisbane was getting, a reasonable share, probably more than its fair share of overseas immigration. Yeah. And the median house price compared to the other capital cities just looked like good value. It looked cheap, right? So since I did that end of 18, from calendar year 19 through to 2023, it experienced just under 10% compounding capital growth over that period of time. So really the median house prices increased 60% over that time. You recall, Jared, because I came on this podcast to talk about it, mid last year, I talked about Perth, saying I think Perth's due for a growth cycle. Admittedly, I've been saying it for a couple of years, but that's when I put pen to paper, and it's up obviously over 20% over the last 12 months. I'm not highlighting this to sort of showboat or show off or anything like that, but it really just is further evidence of that mean reversion kicking in. I think it's not always easy to see, but when you've got to have consideration to the market you're investing in and what the returns have been over the last 5 to 10 years. And if those returns have been quite high, say, for example, Adelaide, then maybe it's not the right cycle to invest in versus, for example, Melbourne or Perth. They're sort of intrinsically undervalued. When you look at those numbers, it certainly shines through.
Well, I did mention in one of my last episodes as well that I thought, you just look at the median house price of Melbourne now compared to Sydney and Brisbane and just blindingly undervalued, as well as Perth. And you don't have to be a rocket scientist to work these things out.
Yeah, that's right. And it's about looking at those long-term trends. Remember, we're making a long-term decision when we're investing in property. So let's try and only be influenced by long-term indicators. Let's try and not be influenced by short-term indicators, which I guess you can take to mean don't read the newspaper because most of that stuff is all very, very short-term. Again, it's interesting thought and conversation, but shouldn't really be informing our investment decisions. So I said there was two things, Jared, that an investor should do, to make sure they maximize returns over the next 20 years. So the first one was think about the cycles where you're investing. The second one is look for alternate uses. Look for properties that lend themselves to allow you to add value. So that could be buying something that's run down. So you're buying something mostly for land value and you can improve it down the track. I'm not saying you should improve it, and whether you improve it is up to you and your strategy, but at least it's got that ability and you can always do that down the track. So that if you're then unhappy with the capital growth, you buy this asset, it's mostly land value, but for whatever reason the market just doesn't perform, well, you can manufacture some equity by either demolishing, rebuilding, building multiple dwellings, renovating the dwelling, whatever it might be. But if you can try and find something that does have these multiple uses, that where you can try and add some value to the property, at least then you're not just relying on the overall market to rise in order for you to earn a return. You can try and manufacture a bit of a return.
Well, I certainly like having that value add potential there, but where a lot of investors run astray with this and also your previous point about timing the market, they often can compromise the long-term potential to achieve either of these things. And that's definitely not what you're saying here. You don't want to go just buying a development site in an inferior location that hasn't had a historical performance and doesn't look to have that longer-term performance ahead of it either. So you don't want to trade everything off.
Yeah, it's spot on, and it's a really important point that you've made, and one that I should have really highlighted. Absolutely. That's an additional element, not an element in itself. So what I'm saying there is you want to buy something that it's pure investment grade. It's a great location, there's strong land value component, there's good historical returns in that location. You're not taking any bets. You're not throwing a dart at a dartboard. What you're doing is, I know this is a pink diamond, I'm going to buy this pink diamond. But also, in addition to that, this pink diamond lends itself to some improvement. So I guess the best analogy is comparing two assets that are in a fantastic blue chip suburb, great floor plans, great aspect, etc., same land size. One has been renovated and one hasn't been renovated. I would buy the unrenovated property for a couple of reasons. Firstly, I don't have to renovate if I don't want to, or just accept a lower rental yield, and it is what it is, and it might still work as an investment. If it doesn't, I can renovate it. And if I renovate it, I'll be able to depreciate the improvements. So I'll get some additional tax benefits there. So it's looking for an investment that has those additional benefits, as opposed to maybe 40 years ago, you go, look, I'll buy the renovated one. It's all good as less hassle, which would have been true. And in a rising market, both of those properties would have done really well. Well, here, what we need to do in terms of mitigating the risk that the market doesn't repeat that 83 to 03 sort of performance, we need to find assets that are really going to contribute towards our return and things that we can do those assets in order to make that happen.
That makes a lot of sense. So where does that leave us? Because, the underlying economic fundamentals are looking really good, aren't they?
Oh, they are. Look, and the supply demand is the really the number one thing to think about, particularly in terms of long term. At the end of the day, we all need somewhere to live, right? So it's a necessity. Housing is a necessity. It's going to happen. And if it doesn't happen, prices rise in terms of supply. So You look at the population growth, the number of houses that we're building. We think about, how much it costs us and how long it takes to build infrastructure in Australia. It's insane. So the density and the problems that creates are going to be with us. So therefore, it's been the case that, well, in fact, if you go back 40 years in Melbourne, whether you lived in a blue chip inner city suburb or you lived outside of Melbourne, didn't really have a big impact. Like in terms of driving times, amenities, all those sorts of things, it wasn't that big a deal. It's only because of this density that now living 5-7 Ks from the CBD dramatically reduces your commute time as opposed to living in an outer suburb. Yeah. Well, that differential, that livability differential only exacerbates itself. And particularly then you overlay, potential undersupply of property, that just makes it worse. So the fundamentals are fantastic, I think, for property in the long term. We just want to learn from history and just make sure we as investors are doing everything we possibly can to ensure that the decisions we make today, that we're going to be happy with it 10 or 20 years' time, to make sure that we're actually going to earn a good return from our property investment.
Well, that makes sense then, to err on the side of the caution, and you look to time things where there's more of that intrinsic value, and look for something value add if that's still going to enable you to get a quality property within your budget. So
spot on.
Thanks for coming on the podcast again today, Stuart. I really appreciate it.
Oh, my pleasure. Thank you for the invite.
And I'll keep an eye on your podcast, Investopoly. Head on over there if you're not already a listener, and we'll be getting you back soon.
Thanks a lot, Jared. Appreciate it.
Bye.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.